Hello everyone, welcome back to Yesports channel for this Friday webinar of finance. This is Summer, your host, and we also have Ayana, Ocean, and JC. Yesports is a global eSport plus social media platform where gamers meet celebrities for fun and opportunities to show their talents. It connects game lovers to a dynamic world of resources and people. Yesports Talent showcase talents from around the world and provides a platform for connecting to corporates to maximize the marketing synergies. We are delighted to have finance expert JC to join the webinar today. Again, our topic today is Finance 101 ETF. Please feel free to drop any questions or comments with us. And JC, would you please share with the audience what an ETF is? ETF is the short term of exchange traded fund. It is a basket of securities that trade on an exchange just like a stock. ETF share prices go up and down, fluctuate all day as the ETF is being bought and sold, which is different from the mutual funds that only trade once a day after the market closes. Hence, ETFs tend to be more cost-effective and more flexible comparing to the mutual funds. ETFs offer all the benefits associated with the index mutual funds, which was the topic that we covered last week, including low turnover, low cost, and broad diversification, plus their expenses ratios are significantly lower. ETF is mainly divided into two categories, which are passive investing and active trading. Generally speaking, passive investment is tracking the market such as an index, and active trading is to be managed by the traders.
節目內容中的個人意見和觀點僅供參考及討論，並不代表 Yesports 的立場。投資者必須按其本身投資目標及財務狀況自行作出投資決定。Yesports 不對以下任何情況對閣下或任何人直接或間接負責。Yesports 的不準確性、錯誤或遺漏，包括但不限於報價和財務數據。Yesports 中節目傳輸的言辭、錯誤或中斷，閣下由 Yesports 中節目內容招致任何損失。閣下確認，本節目只為提供資訊，並不為了任何交易目的。本節目內容以及其提供的資料並不構成任何 Yesports 為售賣任何證券作出招攬、提出邀約、意見或推薦，或對任何證券或投資收益或是否合適提供法律、稅務、會計或投資意見及服務。及 Yesports 並非為任何人士或法律實體在其他司法管轄區或國家使用，而在當地可能因該使用或分發而違反當地法律或法規。
Hello everyone, welcome back to Yesports channel. This is your host Summer, and this is Ayana, JC, and Ocean. Yesports is a global esports social media platform where the gamers meet celebrities for fun and opportunities to show their talents. It connects game lovers to a dynamic world of resources and people.
Yesports Talents showcases talents from around the world and provides a platform for connecting to the corporates to maximizing marketing synergies. We are delighted to have finance expert JC to join our webinar today. Our topic today is Finance 101 ETF. Please feel free to drop any questions or comments with us. And JC, would you please share with us the audience what an ETF is?
So ETF is the abbreviation for Exchange Traded Fund. So as its name suggests, it's an investment fund traded on stock exchanges, or its nickname called listed fund. So basically, it's a simple way to invest in mutual fund, because not sure how many of you have ever invested in mutual funds, but actually if any one of you tried to switch your allocation in your MPF, it's going to take a couple of days. So if you're buying a stock, right, you get executed within seconds. But if you try to switch your MPF, you need to fill in a lot of forms, and it's going to take a couple of days before you can switch the fund. So by buying exchange traded fund, it's going to be much easier. And then so the ETF has a history of about 27 years. The first ETF was invented by the founder of Vanguard Group. So the first ETF came to the market in 1993, tracking the S&P 500. So there's simply two categories in the ETF space. One is the passive ETF, which pretty much keep track of an index, like what we kind of touched on last time. And then the other one is the actively managed or active ETF.
It is managed by the traders, is it?
It's managed by the fund managers.
Fund managers.
Yes. So these are the main differences. So we can probably talk about that in more details later in the session.
Sure. So let's thank you, JC, for explaining to us what an ETF is. So exchange traded fund, and we've learned that should be a basket of securities that trade on exchange, which in my perception it's more, in my perception as an amateur, I think it should be more secure and favorable for the retail investors, especially new people, new beginners. And recently ETF has kind of become a hot topic. And we can see the ads all over the places in the MTR and somewhere else. And 3033. That one, the first ETF in Hong Kong stock market, and it has quite a dramatic change on the listing day. It dropped from $20 to $8. Is it how ETFs supposed to perform in the stock market?
I think that one it's interesting because obviously 3033 it's the first ETF like tracking the Hang Seng Internet and Information Technology Index. So I guess a lot of the retail investors got too excited about the tech index. So, but there is a pretty distinct difference between a stock and ETF. For stock, basically you can have the technical term is like multiple expansion. Okay, it can trade at 15 times PE today. It can trade at 20 times PE tomorrow, or some of the stocks trade on NAV can be at a significant premium. But for ETF, pretty much they should trade close to their NAV, net asset value. That's the key term. So on the first day, the 3033, the NAV should be $7.60 something, right? But there is I call it imperfection in the pre-market session, where because like what drives stock prices? It's supply and demand, right? So you have on one side a lot of retail investors being very excited about the first ETF on the tech index. So that's the demand side. On the supply side, you have the issuer, right? So suppose the issuer will continue to. So if they see great demand, they will issue more units. So to match the demand, so to make sure the market price trade close to the net asset value. But during the pre-market session, the issuer is not allowed to issue more units at that time, so that you have a short time where demand and supply simply mismatched, and a lot of the retail investors simply don't understand ETF well enough. They thought it's just like stocks, so we can just trade at whatever prices instead of it should trade close to the NAV. So very soon after the market opens, the issuer came in, the market makers came in, issue more units to make sure prices get close to the NAV. So that created a massive price fluctuation during the day. And I guess investors learned a pretty big lesson. So remember, ETF should trade close to the net asset value anytime.
Okay, thank you for solving the puzzles for us.
So we have our webinar about the indexes last week. And are there any correlations or links related to ETF?
Okay, so you are probably mentioning talking about the passive ETFs. So passive ETF tracks like index, so can be Hang Seng Index or any published index. So the performance of the ETF should mirror the performance of the index closely. Of course, there's a tracking error which we should touch on what's tracking error later in the session.
Okay, so I've heard that there are more passive ETF in Hong Kong than the active ETF. Why is it be?
Yes, simply it's a cost issue because for ETF, it's for the investors, right? It's a cost-efficient product, right? But on the other hand, okay, if investors pay less, that means the investment manager, the fund managers, will get less, right? So for passive ETF, it makes perfect sense because what you do is you just keep track your portfolio, just keep track of the index. So if you have more investors subscribing the ETF, simply you just buy up the like more stocks in accordance with the index, basically the weighting of the index. But for actively managed ETF, you need a great deal of input from the fund managers, and then
a lot of time.
So if you continue to charge the low rate, the low management fee, that's passive ETF charges. There's no way that you can you can break even. So that's why for the actively managed ETF, probably it's more like the fund managers will probably go for the normal kind of mutual fund way of doing it.
So as Anna mentioned before, like many of the ETF in Hong Kong are passive investment format. So in your professional perspective, how many types are there in passive investments and which industry does this cover?
Okay, interestingly, I think we have a chart, right, showing the distribution. So in Hong Kong, there's 220 ETFs up until now, and then the like 36%, if my memory is right, it's related to China. So it's say Hang Seng China Enterprise Index. So the ETF linked to China enterprises, followed by the Hong Kong indexes. So maybe the next slide.
Yes, this is about the news we talked about,
Yes.
about the technology.
Yes. So
And then shall we the next
think that
within the next few page?
yes, I think probably the next
next
page. Yes,
page.
this is the spread of the 220 ETFs currently listed in Hong Kong. So as you can see, China enterprises like ETF linked to China market makes up 36% of the market. So that's the most significant. And you have some interesting index, like some covering the future market. Of course, that's
Oh,
a very
so-
niche market.
So I can like invest in Japan or Korea like by ETF, not directly buy in the market.
Yes, because okay, say if you want to, so if you like Japan and you want to invest in Japan, it's very difficult for Hong Kong investors to invest in a particular stock in Japan. So it is much easier if you buy into a Japan themed ETF.
Oh.
You just need a normal bank securities account.
Okay.
So we can see that there is a lot of countries on the list. Which one is the most established system of ETF that we can take a reference?
Okay, the easiest or the most famous ETF, apart from the technology 3033, it's our tracker fund, 2800. So that's mirrors Hang Seng Index. Yeah, so that's a tracker fund.
This looks like a pretty drastic changes on this chart.
Yeah, March we
I
seen
think it's like from
yes.
like January this year to date. We can see the tracker fund is like almost the same of the Hang Seng Index, right?
Yes, so I think last time we also touched up on say when we
Index.
talk about index,
Yes,
right?
we did.
So the Hang Seng Index, with the exception of a few stocks that's exposed to the tech sector, a lot of the like old economy stocks pretty much do nothing.
So if I'm interested in like I have a goodwill on the Hang Seng Index, so I can like simply directly go ahead with the tracker fund.
Yes, that's the easiest way, because the other way is you buy all the stocks in the Hang Seng Index according to the weighting of the Hang Seng Index.
So I have to have
But,
a
yeah.
lot of money.
You probably something like I think something like 600,000, something like that.
600,000.
If you buy like just to match the weighting, so it's not that cost efficient. So it will be much easier to just simply buy the tracker fund. Last time you buy just one lot in the tracker fund, the entry price is like 13,000. So it makes life much easier.
So are there any ETFs covering any interesting or newcomer industries?
Oh, of course, yes.
We would like to learn more about it.
Yes, like we do, like the slide we talked about earlier, right? If you there's like very interesting themes, like
Can we
if,
go back to
if
the earlier page, please?
yeah.
Thank you.
Yes, so you have like currency ETF.
Currency.
You have commodities ETF, which back in March, remember, right? There's ETF on oil, right? Which caused like a massive fluctuation. And then you do have like futures ETF. So you do have like, say, commodities ETF can be oil, can be gold, because gold is also very
Some really solid things, right?
yeah. Because like gold is how do you invest in gold? And the easiest way is through ETF.
Okay, so I think this is like the most like popular gold ETF in Hong Kong.
Yes.
And then like people who want to buy gold will go ahead with this ticker.
Yeah. And the other, okay, so if you're buying a stock, right? You simply get a like stock certificate, or simply you won't get a stock certificate because your holdings will be held at the custodian. But with gold, if you're buying gold bars, how are you going to hide the gold bars, right? There's a storage problem, so it will be much easier if you invest in ETFs that you don't need to deal with the storage problem with the commodities.
Oh, so for the storage problem, I think the next slide about the oil will be have the same issue
Yes,
that
yes.
we won't store like oil.
That's right.
In our home, right?
That's right. So that's a pretty drastic event. So we had, I think, one ETF at that time, because they don't buy the actual oil. It's like a synthetic product. They buy oil futures. So originally they invest in the oil futures in the closest months. But then, because of the massive fluctuation in oil prices, they need to revise some of their terms to buy the oil futures in further out. Say instead of, I think at that time it's March, right? So instead of buying April and May futures, they need to roll it into like September futures.
Okay.
But how could it possibly drop that much?
Okay, because a lot of investors thought, okay, at that time we had a pretty extreme situation at that time where all the airlines pretty much shut down.
Right.
So demand for oil dropped significantly.
Yeah.
And then a lot of investors thought, okay, oil prices would have, they want to bottom fish basically. Oil prices already at say a few dollars cannot fall more. They thought, okay, the most it can fall is zero.
Is that the rock bottom
Zero.
already?
So if they're buying like futures at like $1, $2, it's going to be okay. But they forgot that, okay, futures you need to take physical delivery. So how are you going to take delivery if you don't have a huge like depot to take the oil? How are you going to take delivery? So then they need to pay someone to take delivery. So that's why prices fell into the negative territory. So basically, I am selling it to you. I'm going to pay you $10. You handle the storage for me. So that's why oil prices fell into the negative territory for the first time ever. A lot of investors
suffered a lot.
So like I see there's a negative return. Can I say like it's not really common for an ETF like happen in this way?
This is very extreme, very extreme.
So if the oil ETF is like an underlying is like the futures, then I think it's like we better like when we started we better invest in something. The underlying is like a stock, right?
It's okay. Say if you are buying the index, right? Basically, the index ETFs, you are buying like stocks. But for this type of like oil ETF, the one we're talking about, they are buying like oil futures. So oil futures is like a derivative. It's not the underlying stock, right? So for derivatives, it's going to be more volatile, and also like more volatile. And also there are some ETF where you get like twice the return or 3 times or times 3. These are like taking leverage positions. So for these type of like synthetic or structured ETF on structured products, the risk it's much higher.
Oh, okay.
So it's, yeah.
So like seems like ETF have a lot of risk, but why we invest in ETF?
Okay, it's obviously the cost, like what we mentioned earlier, right? If you are buying, say, mutual funds, right? There are subscription fees you need to pay. There are like a lot of upfront fees you need to pay. But for ETF, it's like it's like normal. It's like normal. Plus, you need to invest like a pretty large sum before you can invest in mutual funds. But with the ETF, it's just like buying a normal stock. And then if the ETF is tracking like an index, it's already like a pretty good diversification. Like last time we talked about index in the long run, right? If you buy the index, it's actually the easiest way to invest, because like if you own like a investment portfolio, right? For most retail investors, right, the habit is they keep the bad stocks because they don't want to take the loss, right? So doing like maybe as the year comes along, you end up with a lot of bad stock in your portfolio that you never don't want to get rid of. But with the if you invest in the index, right, they will have regular review in the index in terms of the constitute of the stocks in the index. So that means bad stocks will be removed, the good stocks will be added. So that means the in the long run the index should outperform anyway.
How long do they usually take the review? Like how many times in a year?
Okay, it depends on which index you're talking about. Some you're talking about like half a year, some talking about quarterly.
Quarterly.
Yeah.
So like from the slide, then we can see like I can simply invest in like over around 30 stocks within with just like a 1,500 Hong Kong dollars, right?
Yes.
Okay, then I will use some of my salary to start to invest in the ETF.
Actually, there's a good way. One good way to invest is called average cost. So you set aside, call that, okay, say every month I'm going to put down $2,000 invest in one index. So no matter the index is high or low, doesn't matter. So because over the long run, this is like a cost average approach.
That sounds like a pretty convenient way.
Yes, the easiest way.
No matter why my friend keep like investing in the tracker fund in Hong Kong every month.
It's like actually the MPF, but a lot of you probably never look at the performance of MPF.
Unless they send us some text, we have to look at it.
But actually, MPF, it's doing the average cost approach, because every month you're going to put down money buying the same allocation.
So if we are interested in ETF, like, so how do we pick the ETF?
Okay, so it's so we're talking about, okay, the tracking error, that's the one we talked about earlier, right? So even if you are buying into say Hang Seng Index ETF, technically it should track or mirror the performance of Hang Seng Index, but because of timing to switch, things like that, there could be a tracking error between the performance of the index and the performance of the ETF. Of course, we should pick the ETF with the lowest tracking error. Obviously, you don't want to pick an ETF, like a passive ETF with a massive tracking error. It's okay if you are buying an active ETF with a huge tracking error that's outperforming the index.
Okay, so besides the tracking error, what's the other factors that like will
Okay, The few factors you should look at is one, it's the size of the ETF, the liquidity, because like you want to make sure you're buying into an investment that's easy. If you want to sell it, right, there are always buyers you can sell it easily. So the market size and the trading volume is important, one important factor. And the second important factor is the cost ratio. So just like mutual funds, ETF will charge a management fee. So if you look at the few Hang Seng, the tech index, the 3 ETF on the tech index, the management fee range from 0.4% to almost 1%. If you so because ultimately you are the one who is paying the fee, right? And if the 3 are tracking the same index, right, I should pick the one with the lowest management fee.
True.
Right? And then the third important element to look at, the factor to look at, is the tracking error. So between the 3, right, the 3033 has a tracking error of 2%.
Okay, seems quite high.
Relatively speaking,
Okay.
the other 2 is like 0.62 and the other one is 0.94. So between the 3, you should weight the 3 factors.
Okay.
Talking about liquidity, does that mean that if there are not much participants in the market demanding for a specific ETF, then it will be difficult for me to sell my ETF?
Okay, actually that will not happen because the issuer or the market maker is obligated to be the market maker in the market. So that means, okay, if you want to sell, they need to provide liquidity for you to sell.
And also, would there be any countries that has established history system of ETF that can use as reference for us and all the retail investors? Any examples for that?
The largest ETF market has to be the US, right? Just like the capital market. So there's over 5,000 ETFs in the US market, and it's the biggest issuer. It's BlackRock. They have a 36% market share, followed by Vanguard, which is actually the founder of ETF. It's 25% market share, and State Street at 16% market share. So if you add the 3 together, it's already close to 70%. So they have the most mature ETF market, but that's fair given that they have a very sizable pension fund market as well.
So
What are the differences between mutual funds and exchange traded funds?
Okay, for mutual funds, it's just like a investment fund. You need to, there's usually a minimum subscription. So depending on what type of fund, but usually you need to invest at least like 100,000 US into a mutual fund. So versus this is the entry barrier versus an ETF just like 1,800. Then some mutual funds there's restrictions, so you need to be a professional investor before you can invest. So the definition of professional investor is you need to have asset of at least 1 million US. And then so ETF is a much easier way or more retail way to invest in mutual funds.
And as mentioned that ETF is something like stocks, similar to stocks. And when is the best timing for us to invest in ETF?
Actually, I would prefer the cost weighting approach because it's very as a human, right? It's very difficult to try to buy the lowest spot and try to sell at the highest level, right? It's very difficult. So I would say a big factor is luck. Okay, even though if prices, so how many of you is brave enough to bottom fish in March?
No, not really.
Everyone kind of thought, oh, we are probably the end of the world, right? But like from my experience, this panic scenario, it's probably a good time to invest. But you need there's a psychologically, right? You need to overcome that because it's very difficult to buy at the lower spot. That means in a very volatile, extreme market like that, even though prices would have fallen by like 30% in the past couple of days, could fall by another 20%. So if you buy today, you have to equip yourself that prices may continue to fall. But you know that in this situation, when things normalize, when investors stop panicking, prices will recover.
All right.
Okay.
So it's very, very difficult. You need to go through a couple of market cycles before you can overcome that psychological barrier.
So that's why we can see from the news that there are lots of like ETF were shut down in this year.
Yeah, actually, one kind of signal I look at to bottom fish is if you see all the newspaper or the media saying that it's almost the end of the world, probably it's a good time it's a good time to invest because that's when everyone is bearish, everyone wants to sell, so that's probably the worst moment. But you need the psychological barrier. It's pretty hard to overcome.
You have to prepare yourself for that.
Yes, probably you buy it and then just stop looking
at
at newspaper, stop listening to the radio, stop looking at TV for a couple of days.
So there is, even though I saw a lot of news saying that the ETF shut down, there's still some like good ETF like in the US market.
Yeah, the ETF, the reason why some of them are forced to shut down because they're taking on leverage. But if you are talking about say tracker fund, there's no leverage. There's no way that it's forced to shut down. It's only if you are taking leverage or synthetic products like the oil ETF, something like that.
So so for example like there's a two ETF like tracking the S&P 500 index, almost like the track, almost the same.
Yes.
It seems like low tracking error.
Yes.
And it seems like can quite closely.
Yes. Yeah, because like buying the index is the easiest. Say SP 500. You need to, if you want to buy in like say 10 stocks in the index, right? A good way is you need to do a lot of research on why this is a good stock to buy, and most people just don't have the time and the expertise to analyze the stocks. So the easiest way is just invest in the index through the ETF, and actually if you buy the index, right, over the long run, the performance it's very similar or sometimes superior to the actively managed mutual funds.
I see. So as we all know, Yesports is aimed to create this ecosystem for esports. So are there any esports related ETFs?
Yes, I believe there are a couple that you can share. Yes.
Also the next one.
QQQ.
Yes, as you can see, right, performance has been tremendous, right? Even though we had a short sell-off in March, but it came back all the way. So it's like up 30% year to date, which is very strong performance. Because I think last time we also touched on, right, over the long runs, the past 20 years, stocks or equities, right? This asset class makes like 6 to 7% a year on average per year. So if you're talking about 30% year to date, it's only September, right? We still have another quarter to go. It's already 30%, right? That means you're already making like pretty much 4 years worth of return on the equity asset class.
So if I'm brave enough like to invest in March, then probably I will get over.
Yes. So from
30%
minus 20 to 30%, so you're getting like already 50%.
Oh, I see. Okay, then let's see some gaming or esports ETF.
Yes. Next page, please.
Yes. So very similar trend because that sector is well sought after. So
they have all been increasing for a lot actually.
yes, yeah, because like even with the say Hang Seng Index, right? So it's not doing much for the year, but if you kind of look at the individual stocks, right, the tech stocks or the new economy stocks outperform a long way, whereas the old economy stocks like the property stocks, the bank stocks are doing nothing.
So I can see like the white chart seems the Nasdaq, the 100 stock index, and then like simply obviously like the gaming and esports all outperform the other technology stocks.
Yes. So that means even tech stocks, right, outperform the general index, but the subset of the tech stocks, say gaming and esports, outperform the ordinary tech index.
And it seems like from the graph year to date, you can see like at the very first beginning they are like underperform the Nasdaq, and then after some maybe the COVID-19, so it's still like we can see.
It's fair actually, because for so in March is a very extreme kind of market situation, right? So investors basically need to sell because maybe he has another invest in another asset class that he needs, that he has a leverage position that he needs money to pay for the margin. So he need to sell other assets that he can sell. So even the tech stocks were well sold off basically because of the liquidity. But so that is fair, right, for stocks outperforming, matching with like high volatility. That is also a fair statement.
Like before we talk about the like leverage or inverse ETF, we can maybe go back to the gaming ETF because I heard someone like got some interesting news about the esports, which is maybe a good contributor to the like gaming or esports ETF.
Yes, I have read an article lately that was about many celebrities have actually invested in esports industry such as the background music, and they even participated in live performance of esports events such as Drake, David Beckham, and even Jay Chou. Can we say that this is a good news for with positive impacts and for the esports related ETF?
Yes, that's very obvious, and also they are the guys on
have
the
lots of influence.
Yes, and also they know what's going to be popular, what's the trend basically. So they know the trend well. So that's why they are investing in the sector.
So I have like made a graph about the like the leverage or inverse ETF you just talked about. So like we can see like the white line is the Hang Seng Index.
Yes.
The orange line is the tracker fund is almost like the same as the Hang Seng Index.
Yes.
And we can see like if I'm like Western, then I can buy like 2x or 2 times the of the tracker fund, then probably I will lose more.
Yes, it's also going to be
this
more
year.
Volatile because for the 2x 3x ETFs, basically they are buying like Hang Seng Index futures. So that means if Hang Seng Index goes up by like 1%, the performance of ETF is going to be up by 2%. So basically that's what it means, 2 times. 3 times meaning if Hang Seng Index goes up by 1%, your performance of the ETF should go up by 3%. But on the flip side, on the reverse, it's going to be vice versa. So that means Hang Seng Index falling by 1%, your investment is going to fall by 2 to 3%. So with this investment, it's more volatile, more risky. So for investors, that are buying into this ETF, they should understand the underlying risk.
Also, so compared to like the short selling, I heard about the people
Yes.
like doing short selling are
Yes.
more like risky.
Yes.
If I'm like have a inverse view
Yes,
about the
yes.
Hang Seng Index, which like this year Hang Seng Index is dropping,
yes.
then if I'm like I don't like the Hang Seng Index, but I won't do short selling because of
It's very
risk.
difficult. Very
Then
difficult.
probably I will go ahead with the inverse
Yes.
ETF.
Actually, I would say the inverse ETF, say if you have a bearish view on the market, you think the market has like topped out, so you want to short sell. For retail investors, it's very difficult to short sell. So it's not like the if you study the finance course, you cannot short sell and then get the cash to invest somewhere else. It's very difficult unless you're an institutional investor. So for retail investors, just two ways of doing it. Basically, one is to buy the inverse ETF. Two is to buy the put options, put warrants. But put warrants, put options are even more risky than the inverse ETF because the underlying leverage or the multiples, those are much higher than the inverse ETF. So I would say the inverse ETF, it's a pretty good way if you think the market has peaked or will see some correction. And also for the inverse ETF versus the put options, put warrants, the put options, put warrants, there is a time factor because usually those, talking about maybe a duration of like 6 to 9 months.
Expired.
Once it's expired, it's going to be worth nothing. But for the inverse ETF, okay, you can just hold on to it and wait, say for a day that the market collapses and you get all your money back.
Oh, we have an audience. Like his name is 野影小生之作 Coming Chow Baby. Hello. So he's asked, may I know the differences between ETF and APIF fund?
The ETF is exchange traded, whereas the other funds it's not may not be traded on the exchange. So that's the main difference.
Do you have any additional comments?
Uh, yeah, that's pretty much.
I think the ETF is relatively less risky than
It's the easiest. I would say it's but risk is all relative, right? But say buying ETF is an easy way to, like even tracker fund, right? It's the first ETF in Hong Kong. It's the easiest way to just mirror what the index do.
So like if I am like this year like I bet the Hang Seng Index will drop, then probably I will go ahead with the inverse ETF, and then I can see like if I go ahead with the inverse ETF like the 2x, then probably if I take the profit at the bottom, then I will earn like 50%.
Happy man. Yes, but again, like March is a very extreme case.
Is it called the Black Swan?
It's because like it's almost like the financial crisis.
Unpredictable thing.
It's not as bad as like the Lehman crisis, but it's the magnitude, the way that asset prices fall. It's just like the crisis times.
Luckily, we are all still working like.
So in a short conclusion, so we believe that ETF is more favorable for finance beginners and retail investors.
Yes, it's a much easier product for them to, and also they don't need to do a lot of homework on the individual stocks, which
much
is
time.
And you have mentioned that ETF diversifies risk.
Yes.
However, I've heard that in 2018 that Credit Suisse has disconnected trading. Are there any potential risk for ETF?
So that has to be ETFs with leverage, because
With
everything with leverage means if you may lose more than your original
It
capital.
increase
If
the
you
risk for you.
yes, if you taking leverage,
Right.
that's
I did some homework on
Mm.
that, because I heard this is a big news, but I think this is like a ETN, instead of ETF, because it's like the underlying is like volatility index, something like that, and then it's not much similar to what we are talking about like today.
Well, the volatility index is a very volatile index.
Yes.
So in the finance world, it's kind of very interesting. You can bet on anything you want. Like even you can bet on volatility. If you think volatility will go up, you can long volatility, right? So it's very interesting. But for this type of investment, you need to understand like what you're buying basically, because it's like for normal like retail investors, it's very difficult for you to get like the sense of when volatility will shut up. But if you are like an institutional investors, from the different signs in the market, right? You after you kind of ride a few cycles, right? You get a sense of okay when that will happen. But that is beyond what a normal retail investors can do.
So if I like drink coffee, then probably but I won't like directly go with the coffee futures. Then probably I will search whether there is any ETF about coffee.
Yeah, that could be coffee ETF. Yes. Again, like if you like coffee, right? Buying coffee ETF is much easier, like for you, to get some exposure in coffee than you want to buy the coffee futures. It's going to be very difficult.
So if we are interested in the esports, then is there any?
Yes, we let's take a look at the Yesports index we mentioned last time, and we have some updates here. And what if I choose to invest in one specific stock? Would it be more? Sorry, yeah. Let's talk about the Yesports index we mentioned last time, and this is just for a reference. We don't have it published yet. JC, would you mind telling us the performance about this Yesports index?
So this the performance has been tremendous, like up 10% from the 1st of July. So just like 2.5 months, 10% return. It's very good compared with like the 6 or 7% return per annum on average for equities. So
and it seems that like the drop from the top is not really quick, like instead of the Nasdaq or other technology stock. I heard about my friend like bought some technology stock and so dropped a lot within this few days.
So that's the good thing about index. So so because of diversification, right, it smooths out the volatility of a particular stock. So in good times, it may not be a good thing because when say if your friend bought into a particular stock, it could go up by like 20% in a day, but index usually don't go up by 20% a day. But in bad times, stocks like single stock would fall by like 20-15% a day, but index normally will drop more like softly, gently. So over the long term, that gives you more comfort because for normal retail investors, you don't want to see your investment going up and down,
True.
So
we would like to see a more stable chart.
yes,
Steadily
yes.
grow
up.
chart.
yes.
We can see that Yesports index exceeding the market's expectations. And what if I choose, like if I pick one of the components to invest in, like I'm not following the index, I just pick one of it where I win a lot of money, or I should actually follow the index because of the ratios?
Okay, if you pick, because last time we looked at the there's like 4 sectors, right, with like within the index, and I think it's the education sector outperformed the most, right? And it's good that if you pick the education sector, but if you pick the wrong sector, you underperform the index. So the easiest way is to buy index, unless you have a lot of time looking at the particular stocks, so you understand the stocks very well, then or you understand the sector very well. That's a different story. But for normal investors, buying the index is the easiest thing.
So unless you're like very familiar with a specific industry, otherwise it would be easier and more convenient to just follow the index,
Yes.
right?
Actually, it's very difficult because say if you're very familiar with one industry, like there are so many industries, right? You cannot be familiar in 70 industries, right?
That's true.
Right? Say if you're familiar in just one industry, there are say in the economic cycle, right? You should invest in different sectors, like according to the economic cycle, right? If you are only familiar in one industry, right? So it's always good industry for you, but in that particular time in the economic cycle, you should be buying the other sector instead of your sector.
So are there anything you also like to include?
No.
What about you, Ocean? Anything you'd like to share with the audience?
Let me tell you next time.
Okay, sure. So we really had a really fruitful day today, this Friday, and we're having this webinar. This webinar is coming to the end, and for disclaimer, are you holding any of the stocks we've mentioned personally,
No.
JC? No? Okay. So thank you all for staying with us, and for the Yesports webinar, and thank you again, JC, for sharing all your knowledgeable experience
Welcome.
with us, and please stay tuned with us for more interesting webinars coming next week. See you all next
Bye-bye.
time.